Good morning, everyone, and thank you for joining us today for our monthly webinar Beyond the Field series. I am your moderator, Amanda McLean, the Farm Management Specialist with North Dakota Farmers Union. Today, we're going to be talking about farming in volatile times with Dr. Brian Parman. A little few housekeeping tips before we get started. Again, everyone is on mute, but at any time, if you have any questions or comments, please feel free to type them into the chat or the Q&A, and we'll have time at the end of this presentation for answers and questions with Brian. This webinar is being recorded. If you would like to rewatch it or any of our other previous webinars, please go to YouTube and search North Dakota Farmers Union. And lastly, we ask that when you're done with this webinar, there will be a pop-up box to take our exit survey. We really appreciate you taking the time to answer how we're doing, what we can cover for our next future webinars, and appreciate that feedback. So with that, I'd like to introduce our guest speaker today. We have Brian Parman, who is Associate Professor and Agricultural Financial Specialist with North Dakota State University. Brian is originally from Nebraska. He finished his PhD in economics from Kansas State in 2013. From there on, he spent 4 years at Mississippi State University before coming to North Dakota State University in early 2018. His role at NDSU is agricultural production and finance topics, including land values and rents, farm financial performance, agricultural lending, and production costs for both crop and livestock producers. With that, I will turn it over to you, Brian.
All right, thanks. I'm going to go ahead and start this so I kind of stay on time. All right, we're going to cover a whole bunch of stuff today. No one specific topic, but just kind of a lot of things related to agriculture in North Dakota. And I kind of cap it off with some research and things like that that's been done in the past. So the first thing I want to show, if folks are familiar, or if you're not, I guess I'll explain. We have an organization in North Dakota, the North Dakota Farm Management Education Program, and a lot of data. They're instructors and they have students in their program, and a lot of the data that I'm going to show here comes from that program of them working with a lot of new and beginning farmers, but a lot of established farmers as well. And it's a really good program on managing financials and that kind of thing. But this is from 2025. So whenever we get this data from the Farm Management Education Program, it's always backward looking. You know, we have to finish out the year. So this chart here shows the top 20%, the bottom 20%, the middle 60, all lumped together, and then the average for net farm incomes in North Dakota, the entire state, going back to 2016. And you can really see that for the most part, on average, if you just look at an average, net farm incomes have been around 140 to 160,000 for really the last 3 years, which is a far cry from 21 and 22 when those net farm incomes were over 400,000 on average. And you can see the bottom 20%. A lot of times those groups wind up losing money, and in this case, that's obviously true. Down, 250,000 dollars, and then averaging this last year 163. So when you look at this on the surface, you say, well, 2025 was better than 2024 significantly, as 163 versus 118,000. But this is, and if we exclude the Red River Valley, it was actually stronger. Net farm incomes were closer to $167,000 if you take the valley out of it. And the big reason for that, one of the big reasons, was sugar beets. It was a tough year last year for sugar beets, especially when you look through the data here, whether you were with Crystal or Mindac or whoever. Pretty much across the board, significant losses going forward. Then the other thing is, if you look and we exclude government payments, it drops a bit. I'll just slide back. There's some years where if you take government payments out, so this is 2025 net farm incomes off the Red River Valley, again, about $167,000. If you take government payments out, oops, went the wrong way. A lot of years that drops negative, like 2019, that would have been negative without government program payments. Well, in 25, it didn't drop that low or dropped into the negative range, but it was significantly lower. And then if we remove government payments and crop insurance, it's 2025 still stayed above zero. Years like 2020, which obviously that was the COVID year where CFAP came in and there was a lot of government payments and insurance going into it. That was a big negative number, and same with 2019. So it's not always the case that this stays above zero when you remove those, but with 2025, it did. One of the other things, though, when we're looking at averages as far as incomes across North Dakota, especially out of the Red River Valley, that includes livestock production. And I've said this about some of the national averages. Um, well, in North Dakota's case, cow-calf, but some of the national averages show a net farm income, of 26 looking a lot like 25. Well, the thing about that is how much are these high beef cattle prices offsetting that? Because they're not just high, they're historically high. 2014 was the previous record, and 2025 kind of blew that out of the water. Not quite doubling it, but significantly higher. It almost returns across North Dakota for cow calf producers at almost $1,100 per cow. And our backgrounding um, really looked pretty strong. I don't have a chart on that right now, but backgrounding did really well also. It helps when feed's cheap, livestock prices are high, and they move in your direction while you have them sitting in the yard. So across the board, if you're in the cow calf business, 2025 was a good year, and 2026 is looking that way too. But I want to go back to comparing the Valley from last year versus the non-Valley stuff. And one of the things in ag finance we use are the Farm Financial Standards Council's ratios. Okay, there used to be 21 of these standard ratios, and part of the reason they dropped it to 17 was because, well, four of them weren't ratios. But they're lumped into five categories: liquidity, solvency, profitability, repayment capacity, and then financial efficiency. And we'll kind of go through here and compare some of those from last year. So here's the North Dakota non-Red River Valley for 2025. And the way to read these tables is pretty straightforward. Uh, any of these ratios, like for instance, the liquidity ratio, current ratio, which would be current assets to current liabilities, you want that number over 2.0. If it is, you get a green, which green means good. If it's below 2 but above 1.3, it'd be in this yellow range, which it's not necessarily concerning, but you'd like to see it a bit higher if the number's yellow. And then red means it's a concerning metric. It's a concerning ratio that something's wrong and it requires further investigation. Ratio analysis in general, when you're talking about finance, it doesn't looking at these ratios right away doesn't necessarily tell you what the problem is, just that there may be one that warrants further investigation, in other words. So you look at the non-valley and the liquidity metrics really in the non-Red River Valley have been pretty strong for years, really been strong for 4 or 5 years. A big reason for that and why that one is misleading is when we think about all the farm program payments that have been doled out since really 2018. How are those paid out? Cash. Where do we put cash on the balance sheet, right, as a current asset? So you get this big infusion of cash from program payments or ad hoc payments, and it goes in there and it kind of makes the liquidity metrics look really good, where others not so good. You look at solvency, really don't have a solvency problem in the non-valley area. Debt to asset ratios closer to strong than vulnerable. Equity asset, again, closer to strong than vulnerable, and debt to equity in that yellow region. So really not a cause of concern in the solvency area. Profitability, on the other hand, this has been down pretty low for a while now. Rate of return on assets just barely above 4%, which at 4%, we're starting to raise alarm bells. Same thing with rate of return on equity, 3.5. Operating profit margin low, below 15%. That's red. And then asset turnover in a pretty tough spot as well. And then in repayment capacity, this is still the non-valley. It stayed strong 2025 for the most part, mostly because of the infusion of some of the ad hoc payments. However, the replacement margin, that one's tightened down to vulnerable. Term debt, in a good place again because of those. And then our efficiency metrics all kind of in the yellow there for the non-valley last year. Now, when we look at the Red River Valley, okay, so this is all the farms that would be in the valley. And I should mention that within this data set, when I'm talking about the valley, I'm also talking about the Minnesota side. So they're kind of lumped in together, North Dakota and South Dakota for the valley. Current ratio is not as good. Most of the liquidity metrics not as good. A big reason for that, again, being the beats. Solvency still not in a bad spot. Land values really holding that up, but the profitability metrics for Red River Valley farms last year, which are just kind of pretty tough. Rate of return on assets barely above zero. Rate of return on equity below zero, actually. Operating profit margin in the very low single digits. Again, we want 15%, 3.7, and then an asset turnover rate just barely above red. So the profitability metrics, this would raise some alarm bells, especially if it were to continue for a period of time. And then you look at repayment capacity. Well, when you have extremely low profitability, uh, and not a lot of cash coming in, you can see how those all wound up in the red. And then financial efficiency also looking pretty poor. And then I put this chart together comparing the two regions, Red River Valley and non-Red River Valley. And you can see that while it wasn't a tremendously good year for the non-valley farms, it was significantly better for the non-valley region than the actual Red River Valley region. Part of that being sugar beets, and then the other part of that being how strong livestock was. So when you think about a purely row crop farmer, and we're talking about financial health, again, some of it's lost in the fact that livestock has been so strong that's pulling those averages up, making it seem like things are better than they were. And so every February and end of September, late August, the USDA puts out these net farm income forecasts for the upcoming year. And when we look, this was from September 2025, forecasting 2025. They revised that down. So September of last year, this was the February forecast for, that revised that September number down from 180 million, 181 million net cash income down to about 160, and then net farm income down from almost 180 to right around 150-ish. So a pretty significant drop. And then the projection for 2026. Now, keeping in mind, this came out before the conflict with Iran and energy prices and fertilizer costs shot through the roof. This number right here, they were expecting that 2026 was going to look a lot like 2025 on average, again, with livestock pulling some of that average up. And what was kind of going on with commodities was cash receipts for crops to increase slightly, maybe a slight improvement in commodity prices, but not much. And then cash receipts for all livestock actually expected to go up in 26, mostly because there's going to be more calves sold. Really, it wasn't because prices were expected to be stronger in 26. It's just more pounds of beef actually available for sale. But then with expenses, USDA was kind of, again, this came out before the fertilizer price and energy cost situation occurred. They were expected to be about the same, maybe up 1% year over year from last year into this year in terms of seed, herbicides, equipment, et cetera. You take it all together in a small increase. Now, with the fertilizer increase and the energy cost increase, that makes a significant difference, and we're seeing costs quite a bit higher than that. And then USDA also talked about projecting 2026 having a big increase in government program payments. Okay, so this is 25, and this chart on the bar on the right, 2026, you can see essentially what you got going on, a big increase in ARC and PLC payments. The justification for that really is simple, that the amendments to the Farm Bill, lowering some of those reference prices, making payments trigger at without prices dropping as much as they had to in the past in order for that to happen. And then the other part, Farmer Bridge Assistance, being kind of lumped in to this cropping year. So this isn't quite the biggest ever. That you'd have to go back to 2020, but it is pretty large in terms of expected government payments this next year. One of the other things I track a lot is our interest rates. And this is the most recent survey from the Ninth Federal Reserve District out of Minneapolis. And so the last update was for uh, sorry, this would be, yeah, first quarter. I have it mistyped here. It's not December. It's actually March. It's January 1st through the end of March of 2026. And interest rates basically staying the same. Okay, so you look operating loans, fixed rate of 7.4, machinery loans 7.2, and then real estate loans, I guess, down slightly from 6.9 to 6.8%. I thought there might be a little bit larger decrease in the first quarter of this year compared to the fourth quarter of last year due to the decrease in the federal funds rate that occurred several months back. But it's like I always say, it's not a one for one. And so it's not, it's pretty easy to explain how that they can reduce rates and these rates effectively stay the same to consumers. Big reason being markets have a lot to do with that. And this is again from our farm management education program. And this just illustrates how much within the data set the overall interest expense in dollars has changed over the last 5, 6, 7 years. And really on a per farm basis is $78,500 last year were paid in interest. That's not all due to higher rates. In fact, from 23 to or 22 to 25, rates are actually lower. It's just that equipment and land prices are so much higher, as well as things like fertilizer and requiring higher operating loans. So you're borrowing more money, even though it's at a bit lower rate. You're borrowing a lot more, so you're paying more in interest. And as costs tend to increase, this trend may not slow down much here in the near future. One of the like I'd already mentioned, one of the main production costs that have been really in the news and on people's minds, and for good reason, have been fertilizer prices. Now, I'm not going to spend a ton of time talking about fertilizer here, but I just want to illustrate how big of a change we've had in fertilizer prices. So the chart on the left, the graph comes from DTN. I just pulled it yesterday. They update these every week. So this is from the 15th of May. And you can see what urea prices have done. We came into the year at about $570 a ton or so. And as of right now, it's closer to $860 a ton. Okay, so a huge increase through almost $300 per ton on urea prices. And the adjustment was fast. You look at how steep this red line is for 2026, because the red line represents 26, the green line 25, and the purple line 24. Uh, this price increase occurred in a matter of days, almost maybe a couple of weeks, to shoot up from $600 a ton all the way up to 850, 860. It has leveled off. You can really see in about the last month or so that it's been just kind of hovering at that 870, but I mean, thankfully it's not continuing to go up, but that's still significantly higher than last year by far, and even much above the 5-year average. Same thing with 1034.0. It didn't increase nearly as much as a percentage as urea did, but up from $675 a ton up to about $725 a ton. And that again occurred in just a matter of a couple of weeks. Phosphorus prices, those had remained elevated. If we remember what MAP and DAP actually cost per ton going back prior to the pandemic, a lot less than this and more like the $500 per ton range. We haven't seen those prices well, really since then. Part of the reason for that has been tariffs on phosphorus fertilizers from places like Morocco, well, specifically Morocco, as well as tariffs applied due to the Ukrainian-Russian conflict going on, and they really never fell back to much below $800 a ton. They were over 1,000 at one time, specifically during like that 2022 period. They'd come back down to averaging around 750, 800, but never really recovering or lowering back to that, and that's because of those tariffs. Now, those tariffs on phosphorus really had nothing to do with the current administration's tariffs that had been imposed, with China and all these other countries. This was put in place because of uh, some, I guess, disagreements that some of our major manufacturers of phosphorus fertilizers had with some of these other countries' practices as far as trade goes. And so that's really why they're there. And there's been quite a bit of lobbying, I suppose, on behalf of on different entities trying to get some of these tariffs removed. But until then, while they are higher right now than they had been a couple of months ago, again because of the conflict with Iran, we're probably not going to see them come back down to $500 a ton anytime soon. I know we don't use a lot of anhydrous in North Dakota, but it's kind of the precursor. It is still the cheapest per pound of N fertilizer product you can put on there, but it's back up over almost approaching $1,200 a ton. And then potash prices, they've stayed flat a big, mostly because yes, we import most of the potash that we use, but we mostly get it from Canada. Almost all of what we import, we get from Canada. So it really hasn't been impacted by any kind of conflict at all. What I'll say about fertilizer, the last thing is we produce most of the nitrogen fertilizer and actually phosphorus fertilizers that we actually use. So supply, as far as supply goes, the actual physical product, we're not as impacted as, say, countries like India or Brazil who import the vast majority of nitrogen and phosphorus that they use. What we are impacted by is the market price because it actually costs more to, for instance, barge it from where it's made on the Gulf Coast up to North Dakota than it does to send it overseas to like Europe. So if they can get, for instance, on urea, $900 a ton trading it or shipping it abroad, and folks up here are only willing to pay 800, they'll go ahead and sell it. It's a globally traded commodity at this point. So we are at risk of global prices on fertilizer, but on most of these products, on the actual supply, the actual physical ability to acquire it, not as much. So that's something to keep in mind. So this is my attempt to use Copilot. I said make this chart. This is what the prices they came up with. I'm not sure how accurate that is, which is why I put Copilot generated images there. But in the interest of shifting gears in this conversation, I wanted to go ahead and put that up there because I do want to talk about equipment and what's been going on in agriculture equipment related. So here's a chart here showing the cost per acre, and I have inflation adjusted this for corn and soybeans across the northern plains. This would include Minnesota, North Dakota, Montana, South Dakota, and Wisconsin. And I'll tie all this together in a minute, but I just want to direct your attention to we had a big run up in equipment costs from 2006 to 2013. And what that did was increased our cost per acre, equipment wise, of producing corn from $60 an acre to $100 an acre in a few years. And then on the soybean front, from about $45 an acre, 45 to 50, all the way up to just over 60, $65 an acre. So we saw a big increase. A lot of that was due to high commodity prices during the period, high soybean and high corn prices, a lot of folks replacing equipment, driving up equipment costs. But then from about 2014 down to 2020, we saw those costs per acre go down. Now, that doesn't mean equipment prices went down. We were just spreading it out over more acres. We were able to do that. And so that brought those per acre equipment costs lower. But then that trend reversed in 2020, and we all remember, 21, 22, where equipment costs were exploding. And my next chart kind of shows exactly how much. This is the producer price index for farm machinery in the US. And what this is really showing is, okay, all of the equipment that you might purchase, whether it's combines, tractors, uh, pull type equipment, doesn't really matter. Uh, Historically, it kind of increases at a fairly steady rate. And then if we recall the trade war in 2018 and 2019, where we put tariffs on steel and aluminum, we saw a little bump there in the overall index. But this is what happened in that period from 2022 all the way through early part of 2024. Just really an unprecedented jump in equipment prices. And since then, things have leveled off. But I was always cautious to mention to folks yes, this rampant increase in equipment prices would stop at some point, but it doesn't mean that prices will go down. It just means they'll stop inflating at the rate that they had. And as a result, we're stuck at this much higher you know, equipment cost than we were just 3 years ago, albeit not growing as fast as it had in the past. And I'm going to tie a lot of this together here in a minute, but the next conversation, real quick, is discussing farmland in North Dakota and land prices. So every year I put out a news release through NDSU Extension, Ag Communications, and what we do is we take the surveys on land prices across North Dakota. They're done by the Department of Trust Lands, and then I do a weighted average calculation based on how many acres are in each county. And the reason I do that is so that and by the way, these are the North Dakota State University budget regions, so the NDSU extension regions. And the reason I do that weighted average is so that one county with just a few acres, but there's one sale that's really high in terms of dollars per acre, doesn't have an outsized influence on state average or regional average in land prices. And so this is cropland for North Dakota, and each little box shows what the price was per acre in 2020 versus 2026, the most recent. And just point your attention to some areas like the Northwest. I wonder if, yeah, I think I can pull this up. This will help kind of direct some of that. But this went up, basically increased, doubled in since 2020, up from just under 1,100 an acre to 2,000. You see in the Red River Valley, didn't quite double, but up from almost $4,000 an acre to 6,500. Again, this is an average. This is taking all of it in there. So I know we've seen some sales much higher than, a lot higher than $6,500 an acre. But when you're marking trends and what's going on, this is kind of telling. The North Valley, up almost, $2,000 an acre on average in the last 5 or 6 years. One of the interesting trends, just as an aside that I'll point to, is for the longest time, the South Red River Valley and the North Red River Valley North Red River Valley was the second most expensive land in the state. The South Valley was the most expensive and still is, but the North Valley was number two by kind of a wide margin. And you can see that the southeastern part of the state has actually really kind of caught the North Valley. And a lot of that has to do with corn and soybeans. If you have the ability and the climate to increase the number of planted acres of corn and soybeans, and the Southeast certainly did, it actually caused it to grow quite a bit faster than some of these other regions, really, really catching it. So that's an interesting fact about the state there going forward. And then on the rent side, now let me back up real quick. But what we didn't see this last year was a big increase in land prices for the first time in several years, really since 2020. Statewide average less than 1%. And a lot of that's just, I would almost call that nothing. The data is not strong enough to say that it was literally 0.9%. This to me could be anywhere from a slight decline to a slight increase to zero. So that's kind of how you want to read that. But I will say we do know enough from this that the momentum that land prices had is have subsided substantially, that it's really, really decreased across North Dakota. On the rent side, a 2% increase statewide. Uh, Not all that surprising, especially given that margins have been pretty slim. And I've said in some of the other news interviews that rents are typically slower to react than land prices, mainly because rents are contracts, often a couple of years. So it may take some time for that to filter through. So if we were going to see a decrease in rents statewide, it would probably take another year or so before we really baked in some of these additional contracts and rolled off some of the ones that had increased in the past. Pasture land, though, that one has increased. Pasture land values up 7% statewide. Um, that's not all that surprising, especially when I showed you what livestock prices have done, not just in last year, but the year before they were pretty strong. When we do this, though, I don't include the Northeast, the North Valley, or the South Valley, mainly because there's just not a lot of pasture land that gets bought and sold or rented for that matter. So there's not really enough data points to actually put anything together from that. But nonetheless, pastureland values up 7%. Uh, I think a lot of that's driven by strong livestock prices, mainly beef cattle, and producers who are looking for something that, an opportunity for growth. Even though we know that these livestock prices won't hang out forever, this is maybe an opportunity to increase their operation in the future by acquiring some more land. The flip side, though, is pastureland rents really didn't move much. And it can be kind of counterintuitive on the pasture rent side. You might think that high beef cattle prices should drive up rents in much the same way that high crop prices can drive up cropland rents. But a lot of it has to do with the reason that prices are high. And, one of my colleagues, Tim Petrie's, talks about cattle inventories being record low or historically low. Well, if you have low inventories, and that's the reason for the high prices, then there's not a lot of cattle out there. And so I'm not going to go bid up rents for additional grass for cattle I don't have. That doesn't make any sense. No one does that. So uh, the fact that beef cattle prices are high because of very low numbers means that there's just not a lot of pressure to go out and rent additional grass. And so then there's just not the pressure on pasture land rents, but they're basically kind of pretty close to even compared to the year before. So here's North Dakota's average land values in dollars per acre that I have going back to 2012. We had a big run up from 2006 to 2013. Then, oh, this is adjusted for inflation, by the way. Then they stayed flat from basically 2015 all the way through 2020. Then we saw a big increase that we're all aware of in the last 3 years or so. Sorry, switching on to rents. Rents have stayed flat as well from 2014 to 2013. Or sorry, 2013 to 2020, excuse me. This is adjusted for inflation, just like cropland values are. But then rents did increase, but not at as fast a pace as land prices did. They were going up single digits, mid-single digits, whereas cropland prices during the same period right here were only going up, or we're going up like 10, 11, 12% year over year until this last one where they were basically flat. And so we arrive here, and like I said, rents were up slightly, but not dramatically in the last year. And so I like to go through all that to go to this. Uh, this is the bottom, the lighter red line is inflation adjusted land values, and this darker kind of maroon colored line is inflation adjusted rents. So like I said, when we had this, my chart didn't come out as well, but this is about 2006 to 2012. We saw that rents and land prices went up, but land prices went up way faster. And then we go 2020 to 2024, 2025, land prices went up actually significantly, even adjusted for inflation, whereas rents, they did go up, but when you adjust for inflation, they stayed basically flat. And then the bottom chart is the rent to value ratio. Okay, so that's where I take cropland rental rate divided by cropland values. And I do want to caution you, this is not a cap rate. I don't have a ad valorem or property tax deduction or a management fee deducted, any kind of opportunity cost that. It's just rent divided by value. In 1989, this value was 9%. You can read it like a percent. So in other words, if land prices were $1,000 an acre, the rental rate was $90. This had continued to fall really since that period of time. By here, it was around 5%, right around 2006, 2007. And this last couple of years, it's been around 2.3 to 2.4%. So if we still had $1,000 an acre cropland, your rent would have went from $90 in 1989 down to $23 in 2025 and 2026. So really the amount that you're paying compared to the market price of the asset is really low. And that adjusted a little bit this last year because rents were up kind of flattened out, and land prices when adjusted for inflation declined a little. But it's still hovering in that extremely low range. Now, another thing I'll point out is typically the prevailing consumer interest rate had been about 1.5% to 2% higher than this ratio. And it would make sense. I mean, if you were going to borrow money to buy farmland, for instance, it doesn't make a whole lot of sense to pay, I don't know, 7% interest with a 2% rate of return. That doesn't make a whole lot of sense. So as a result, I think that ratio or that relationship had been kind of maintained for a long period of time. And as interest rates dropped, so did that ratio. But now here we are at a period of time where right now consumer lending rates, and I just showed you across the district that like real estate loan rates were about 6.8%, but this rent to value is still, down around 2.3. And this, I just want to show this. This is from the Kansas City Federal Reserve, and all it does is kind of reinforce what some of our observations were. In their survey, North Dakota had a 0% change in cropland values from the previous year at the end of 2025. So again, it just their surveys kind of showing the same trend that we are. Finally, this is cropland in farms across North Dakota from our farm business management records. Uh, it only goes back to 2005, but uh, we have data going back much further. And I can say that in 1995, the average farm size within the data set was about 1,000 acres. And about 500 acres were owned, and 500 acres, some combination of cash and share rented. So about 50-50. If you look at the last couple of years, 24 and 25, the average farm size is significantly higher than that. In fact, more than double. 2,300 acres, 22 and 2,250. But the number of acres owned, you look at this bottom of the table here, has really been between 490 and 510 acres. And it really hasn't changed as people have moved in and out of the data set. This is really kind of the common farm size. And I think a lot of that has to do with whether folks were making this decision with what I'm about to say in mind or not. If I can rent ground for 2.5%, or I got to buy it and perhaps borrow it at a much higher rate, or I have to buy equipment, which has gotten more expensive, the decision has been based on the data, buy the equipment, lease the land. That's what's been going on, or at least that's what the data has been showing. And it makes a lot of financial sense that if I can rent the asset for 2.5%, and I know land and equipment are not obviously that comparable. One's a depreciable asset, one is not. And one tends to increase in value year over year, but it's that increase in value that's really justifying the market price, not the amount of income it's generating. It's really speculation for the most part. And so I want to go through something here towards the end to kind of show what this relationship with land and equipment has done in agriculture. So this is from that same data set, the FinBin data set. So this is in the Northern Plains, Minnesota, North Dakota, South Dakota, et cetera. And this is net cash income. And I do want to draw your attention real quick. This is 2007, kind of an unremarkable year as far as net cash income. We look at 2012 as it used to, that was when I first was hired here, the best year in North Dakota crop production history in terms of net income. 2022 and 2021 kind of, I wouldn't say blew it out of the water, but went past it with higher net incomes, higher than 2012, higher than 2013, and a lot higher than 2007. And that's net, not gross. And then you look at the net farm income to gross income ratio. Well, 2007 was actually pretty good. And what that's indicating is net farm income, the amount of dollars that our producers are keeping was much higher in 2007, even though it wasn't a spectacular year in terms of net incomes. In 2012, if we look at it from this perspective, was significantly better than 2021 or 2022. And in other words, even though 22 and 21 generated more net dollars, the amount we spent to have that amount of net dollars was a whole lot higher in these years. And since we're doing it via ratio, this takes inflation out of it. It's just what percentage are you keeping versus what are you spending. Move forward here. And so this is something that's been concerning me now for several years, and that's this continual decline on the rates of return on assets and equity. And I guess the other way to say that is the increase in land prices and equipment costs compared to how much money our producers are making in row crops. So I pointed out 2007 for a reason, and this is the reason. The rate of return on equity in '07, which was in terms of net overall, not that remarkable of a year, was over 16%. And the rate of return on assets was over 12%. Why is this so much better than these previous years? What happened? Land prices from '06 to 2012 and equipment costs exploded. Okay, this was one of the big run up before the most recent one in the last 40 years, really since the '80s. Then uh, we look at 2012. Yeah, we had a big run up in land prices and equipment costs, but rate of return on asset equity was still pretty good. Uh, I'd say very good, approaching 18%. Rate of return on assets just over 12, so 13% there. Again, 2021 and 2022 were the highest net income years on record, not just in North Dakota, but nationally. Look at what these rates of returns have fallen to. I mean, the greatest ever, and it's 12. And then the rate of return on assets, below 10%. And 2025, which in net wasn't that or an awful year for a lot of our non Red River Valley producers. I know it was pretty tough in the valley again because of beef. But this rate of return on assets and equity in 24, I should say, is pretty low, and then in 25, which hasn't been plugged in yet, is even a bit lower. And so you might, and so there's the solution to that mathematically is, well, we just need to have higher net incomes, higher net farm, higher net cash, higher cash incomes gross. But I would put this question to the audience. If incomes went up quickly, let's say in the next few years, what do you think would happen with land and equipment costs? Do you think that they would stay the same so that this downward trend in our rates of return on assets and equity would improve? I I have my thoughts. My impression is no, that we would see a big increase in land prices and equipment prices, and this trend would not reverse. We would not have an increase in assets and equity going on. It might even get worse if they jumped high enough faster. And really, I guess the takeaway from it is costs on farmland and equipment have been growing faster than incomes have. I don't know how long that's sustainable, but that's what's happening. And so it brings me into this point here, and I just want to show it. This is applying what in finance you might call the earnings multiples to farmland and income. This is for, an example from the '80s. From 1960 to 1975, farmland was effectively undervalued because the price to sales ratio, okay, so that's just the market value of farmland divided by revenues. And then what I'm calling margin in this case is net farm income divided by cost of production. Okay. We had a high margin environment in from 60 to 75, margins upwards of 30%, and the price of farmland compared to the amount of money it was generating, that's a pretty low number, is really 2 to 3 times. So that would be an undervalued asset in this exercise. So then we come to the early 70s, early to mid 70s. The margin stayed pretty strong, 25% on average during that period of time, and this price to sales ratio increased. So this would be a high margin and a high price to sales ratio period, which that's what we would call stable. Okay, it makes sense. You're generating a lot of money from the asset, therefore the asset is worth a lot of money. Pretty straightforward. Then from 77 to 1985, margins plummeted. I mean, they got cut in half, down to 12%, in some years 15%. But this price to sales ratio, because of this period here, had doubled. I mean, up to 7.5. So essentially, the value of farmland was 7.5 to 8 times higher than the amount of revenues you generated in any one year. This would be an overvalued situation. So then there was a correction. Everyone's aware of it from in the mid 80s. Farmland prices got cut in basically half in a matter of 18 months. So the price to sales ratio dropped almost in half, not quite, 4 to 6, and the margin hung around 20% for a long time. It actually beyond 1995, really. And this is just a chart tracking that exact period, with the blue line being margin and the red line being price to sales ratio. This is the '80s. Okay, we see margins dipped pretty big, and then this price to sales ratio went up. Um, and then when margins improved a bit, price to sales ratio went down because land prices fell. And we just kind of hung around this margin of 25% or so, plus or minus, for the better part of 20 years. But this price to sales ratio started edging up again. And then it really edged up. This is that 2006 to 2012 period. It was a high revenue period, high margins. So we had high price to sales. This is what we're seeing, what we saw from 2014 to 2020. Now, if this relationship held, this should have declined because land prices should have declined because we had margins down around 15%, but it didn't. Land prices held up. And then we've seen margins now that are still about average for the last 35, 40 years, but the price to sales ratio has never been higher than it has been the last few years, where uh, the price of farmland is anywhere from 20 to 23 times higher than any year's revenue. This is what I'm talking about, what's leading to this decline in rate of return on assets and equity, that we're not really generating inflation adjusted more money than we were 15, 25 years ago. It's just the price of farmland is just going up. And it's really not an income driven increase. It's a speculative, so to speak. I mean, it has to be something, and speculation is the reason. So I just want to point all that out to say that it's a situation where I don't have this magic solution to how to correct some of that, but I don't also know how long this is sustainable. Um, for incomes not to justify the actual value. Now, somebody may in the audience point out that farmland's always been overpriced, and that's true, but never more than it is today. And this is by orders of magnitude more. So I don't believe it's sustainable in the long run, that something is going to snap back. I don't know when or how much, but there is going to probably be and I guess one of the things I talked about in my live talks when I've discussed land is there is a soft landing scenario, and that soft landing scenario is we wind up with a inflation adjusted flattening of farmland for 10 years or something like that, and incomes gradually increase, rents gradually increase to kind of close that gap. Will that happen? I don't really know, but that's the least painful method to adjust for that. So last thing I want to leave you with, this is again my attempt at AI. Is there anything we can do about it? And what I'm about to suggest is more of a long run. Also, this is AI. I don't know why whenever I farmer image, they give me something like this. I don't even know anyone who dresses like that, but that's what they gave me. I just want to talk about some research I did in the past on efficiency, just real fast. So we had when I was working on my PhD, I wanted to talk about how to basically retain the most or the highest percentage of dollars invested for what we're keeping. Okay. And so we have four metrics in economics: cost, efficiency, economies of scope, and economies of scale. So three, but you subdivide economies of scale into multi-product and product specific. But how efficient are we using or what size farm is most efficient with the dollars spent? Okay, that's essentially what the root of what this is getting at. And these are some pretty straightforward metric: cost efficiency, how much are you producing for every dollar spent? Economies of scope. This is where a livestock and a crop producer might, they've got some synergies going on there where, they don't have to pay themselves basis for the feed that they keep, and they don't, the shipping costs are lower, those kind of things. And you can use your sprayer tractor to also grind feed at the same time. So that reduces some of that cost. And then economies of scale, we're kind of familiar with that. Uh, you have to be big enough that you can actually afford to spread out some of these costs over a number of enterprises and acres. Uh, and one of the biggest and most important concepts about what I'm talking about here is being the most efficient doesn't mean the highest yearly profit. The biggest, when commodity prices are high, a lot of times the largest makes the biggest pot of money because they're the largest. But for every dollar they're spending, they might not be getting the most back in return. That's the difference between efficiency and highest net. Okay. And a lot of times within the data we looked at, inefficient farms were the larger farms. Some of it kind of at the small side and on the large side, those were the most inefficient, mainly because what's our biggest constraint in agriculture in terms of a resource? Some people say land, some people say money. The truth is, it's labor. Labor is the biggest constraint we have. So if you get large enough, there's things that maybe just don't get done as well, uh, things that get undone, or things that get put on the back burner that a smaller operation takes care of. And so, like I said, this is on the scale side. You need to be big enough to fully exploit the economies of scope and scale, but not you know, too many non-working hours means the most scarce resource labor not being fully utilized. I just want to get to the end here. So here were the categories that we had in the research. And this was all in gross revenues, and I inflation adjusted this upwards so that it makes more sense today. We had farms of less than 150,000 in gross, 150 to 375, and these categories, you can read them, all the way up to 5 million in gross revenues. Then we had livestock only, crop only producers, or those that did both, mixed crop and livestock. So the scenario would work out. Uh, this is your gross revenue category, and then did you fit into one of these bins, livestock only, crops only, or crop and livestock? Okay, so each one of these then had three subcategories. And so what I want to ask is, which group do you think was the most efficient? And since I can't see any of you, I'll just go ahead and fast forward to the end. It was actually these mid-sized farms, so 750K up to 1.5 million, that produced a mixed cropping group. And it didn't really matter if you were mixed livestock and crop or not. These were still the most efficient, even if they were livestock only or crop only. And really the biggest thing that we found was, so how big is a farm that size? What does that look like right now? That would be two full-time operators. And across that was the most efficient size. You would have maybe two brothers or a brother and a sister or whatever, or one guy and a hired hand. That was the most efficient farm size. Again, they didn't always make the most money in any given year, but for every dollar they spent, they got the most in return. So either they lost the least when times were tough, or when times were good, they still made out really well. But for every dollar they spent, they kept the most. And why I think this is important is this is more of a long range planning thing, is when we think about growth or optimizing our farm size, are we just looking to at the best year that we could possibly have? Is that how what we base our planning off of? Or are we looking at, can we bounce a little bit? Can we adjust? Because when you get so large and you're kind of committed to certain cropping systems, it gets really tough to adjust when commodity prices change, or tastes and preferences and trade shifts. You become inflexible in a sense. But at the same time, you do have to be big enough to utilize what a lot of these large pieces of equipment that exist overall. So that's just something to think about. And I guess the last thing, um, the trend that we saw when I kind of first got into this, you kind of set your equipment complement to your land and labor complement. So you took an assessment of how much land I have, what I got for labor, and then we buy equipment accordingly. What it kind of turned into for the last 10 years was we have this equipment, and then we make our land decisions based off of what we've got for equipment, kind of backwards, theory. And when we taught this stuff in farm management class, that's like backwards from how you would actually do it. But that's how things have kind of transpired lately. So again, something to think about going forward as you're, planning and thinking about your overall operation. So with that, I'm going to go ahead and stop my screen sharing. I think I've stopped.
Yeah.
Okay.
Well, thanks, Brian, for that information. I guess now time for questions. One question that came in is, so are the high land values due in part to investment pressures, non-farmers using the land as a store of wealth against inflation? Are farmers or investors propping up those prices?
Great question, and I get it a lot because it makes perfect sense. In some instances, uh, investors do buy farmland for investment purposes. But one thing I'm always careful to point out is if you're an investor, you're not in love with what you're buying. right? You're looking for a deal. And I know some investors who actually buy farmland and things like, or have in the past for investment purposes. And some of them will go to 40 or 50 auctions and just wait until they finally see a deal. They're not going to bid it up. If I'm an investor, I want to get it at the lowest price I can. I don't care whether it's where it's located. I don't care who it attaches to. I don't care about any of that stuff. I don't care if it's Montana. I'm just, I'm going to own it for an investment purpose, hold it for a while, maybe flip it in the future. I don't know. Who do you think is the one who stays there at the auction and bids it up? It's not the investor more than likely. It's the producer who owns this quarter next to it and has always wanted it, and it came up for auction for the first time in 50 years. That's who bids it up. So, is investment pressure a factor? Of course. Yes, it is. But I would argue that in some cases, or well, not in some cases, but somewhat recently with higher interest rates, investment pressure is maybe lessened a bit, just because there's better returns in bonds and other things. And in fact, CDs are returning higher than 2.3%. Now, again, CDs don't have a capital gain attached to them, but they are guaranteed. And the other thing was I fielded more calls in the last couple of years of people from that you would call them an investor, but they inherited the land with a brother and sister or a couple of sisters or whoever. What's my tax basis? Because we're looking to sell. They see what the prices of land are. They want to go into some other fixed income assets like bonds or whatever that guarantee them 4.5%, 5%, and they're looking to move out of this. So a little bit of mixed, and but then I've talked to some auction houses who say, yeah, there's still some investment pressure in there, and they're still buying it up. The one that's the outlier, though, that I don't pay too much attention to, but it does happen, are the hunting, conglomerates that go out and buy. But that usually impacts pasture or rangeland, not really cropland. No one's going to spend 9 grand an acre for that for cropland for hunting. That's usually bid up on rangeland and stuff. And a lot of the reason that happens, you get 3 or 4 people together who they bid it up way above market, but they're only paying a fourth of it, so they don't care. But that does happen. But that's usually more tied to rangeland than actual cropland.
Okay. Thanks, Brian. So as you know, a lot of the prices have been, especially for corn and soybeans and wheat, the markets have been pretty low. So a lot of people are looking more for diversity, different crop value added crops. So when does diversity mean improving resilience? And when does it just add complexity or dilute the return? So when is this balance of adding some value added really going to make a profit versus maybe it's just more work than it's going to actually return for a producer?
Well, here's something that I think a lot of our folks who might be on here who've been farming a long time can relate to, and maybe some of the young folks haven't thought about. North Dakota is one of the most diverse crop states, maybe the most diverse crop state in the U.S., period. I mean, if you live in Iowa, you raise corn and soybeans, you've always raised corn and soybeans, and that's all you're ever going to raise. North Dakota is, previously known for everything from field peas and lentils to sunflowers to barley to spring wheat to corn. Corn and soybeans are really newcomers on the block if you go back a few decades. And so when you're that diverse as a crop producer, what does that mean? Different planting windows, right? Your planting window. So if you're, for instance, going to raise spring wheat and barley, or barley, spring wheat, then corn, then soybeans, then flowers, all those planting windows are slightly different. It's earlier for some of the grass crops, later for soybeans and stuff like that. So what could you do? I already said that labor was your most scarce resource. Well, now I have a much longer planting window to be in the field because I'm not just planting 3,000 acres of beans. I've got some of this and some of this. So I can do what? I can have a smaller planter. I don't need as big a combine because I start harvesting spring wheat way before I harvest soybeans and corn and sunflowers. So I can have a smaller combine as well. I also don't need as much labor because I'm spreading my labor out over many months instead of just a really hectic 3 weeks. And that's kind of how it used to be in crop production. But now if I'm going to only plant corn or only plant soybeans or maybe just both, I got to buy this great big planter and this humongous combine and a big grain cart because I got to get it in the field immediately. I got to get it out of the field when it's ready immediately. And what do I do with those other hours in the summertime that I could be productive, but I'm not as much because I just don't have the crops to utilize. And going back to the research I was talking about, that's why the crop and livestock producer was so efficient was most of the livestock work, at least I'm from Nebraska, much of it's done in late fall and over the winter and then into early spring. Well, we're not doing any farming during that period of time, no irrigation equipment to maintain, really nothing else. So you're taking labor hours that are sitting idle and actually putting them to something productive. And even if you don't turn a what we would call economic profit, if you're just covering overhead and everything else, you're actually ahead of the game. If you've paid yourself and done everything else. So those are opportunities or now I do get the commodity price issue and things like that. And why did we shift to this other production system, two crops or one crop? It's because that's what the market's asked us to do. And it also drove up land prices. Just a quick anecdote on that. Southwest Nebraska, a lot of winter wheat was planted in what was called summer fallow, where you would leave one area bare, and they do it in strips. Sometimes it was an entire field, but usually it was in strips. This strip would be bare, this strip would be planted, and then it would reverse the next year. So you're using 2 years moisture for one year's wheat crop. Well, then they started just planting it all every year to wheat with some advancements in genetics and everything else. Then that land price increased as if you can get one crop every single year out of it. And so it makes it awful challenging to go back to the way it was when you've paid a price for something as if you get one for one instead of two for one. So I know that the switching isn't just some trivial change. It's going to be maybe a generational thing, but that's probably one of the things to think about moving forward.
Great. Well, thank you, Brian. We are over 11, so I am going to end with questions here, but thank you again for joining us today and sharing your expertise. If anybody ever has any questions for Brian, I will be sharing that information out. I also want to put a plug in. If you don't know that NDSU Extension, especially Brian and his colleagues with the Agri Economics, they do a monthly webinar that is called the Agricultural Market Situation Outlook. That is always the second Thursday of the month at 10 a.m. Again, join us for our monthly webinar, the third Thursday of the month at 10 a.m. Your guys' is at 1 p.m. Sorry about that, Brian. But
Central, 1 p.m.
yeah,
Central.
1 p.m. Central, and ours is at 10 a.m. Central on the third Thursday. Next month, on June 18th, we'll be covering what matters smart insurance for farm and ranch operations. Again, thank you, Brian, for taking your time, and thank you, everybody, for joining us today, and hope everybody has a good day. Thank you.
Thank you.
Bye.